The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Michael Blackburn, and on the call today we also have Michael and Franco.
Hi, everyone.
Welcome to our Warning Signs of Troubled Companies webinar. This is our flagship webinar where we condense a lot of the different analysis we present in our reports and other webinars throughout the year. We'll review a variety of the operating, financial, and cash flow metrics that we evaluate when trying to ferret out which firms are troubled and which ones are healthy. The slides and the audio today will be posted on our website, most likely by the end of the day tomorrow. And throughout the presentation, we're open to questions and answer any questions from the audience. There's a little chat box you should see when you logged in. You can go ahead and type your questions there anytime during the webinar, and we'll be happy to stop and address those as we move along. So for a credit manager, there's a fine line between maximizing revenues and being caught on the top 20 creditors list of a bankruptcy case. You don't want to look like this little fella caught blindsided with an account that just filed Chapter 11. So the key to successfully walking this line is not only to spot, but react to warning signs of troubled companies, using the ratios and analysis presented today to spot a red flag, and then giving yourself plenty of time to measure and calculate an appropriate response. So we want to give you the tools to adjust and readjust your credit exposures based on the current and projected credit files, and concentrate on those accounts that desire the most attention. It's kind of like the 80-20 rule, where 80% of your accounts are fine, 20% of those accounts are going to be the trouble accounts, where you should spend most of your time evaluating and making sure that you're properly managing your credit risk. Ultimately, the goal is to develop the skills to allow you to, again, to maximize revenue while minimizing your overall risk. To start off, like I always do with this webinar, the sage Yogi Berra, it's tough to make predictions, especially about the future. We have tools, but we don't have a crystal ball. But we do have tools to look into the future. What we've seen the last couple of years since the pandemic is that crystal ball is really, really cloudy more than ever. We've seen a number of sectors and accounts go up, then down, and others went down, then up. And we continue to deal with supply chain issues. We've got the impact of the war in Ukraine and how that's impacting a lot of commodity prices across the spectrum. So there's a lot of issues that we never had to deal with before that we now are struggling with, and making these tools and analysis that we're presenting today even more important than ever. So we're going to cover the operational and financial trends that we really want to pay close attention to, again, to weed out those troubled accounts. So I thought I'd introduce some basic theory before we hit the specific ratios, starting with the three key financial statements that companies prepare. And each one of these statements tells a slightly different story, starting with the balance sheet, which shows every company has to start with a balance sheet. You have to have cash, you have to raise capital, and then you buy product. So you generate assets. You take your capital and you purchase assets, whether it's inventory or fixed assets, and then you turn those assets into sales. Now, so the left-hand side of the balance sheet shows you those assets. The right-hand shows you the liabilities and the equity, or how you finance those assets. So that kind of tells you the financial health of the firm and those accounts at a single point of time. The income statement, here we're covering the operating performance of the company. How much stuff did they sell? What were their expenses? And what profit ultimately did they generate from the sale of those goods after they paid all those expenses? Did they have any interest expense? How much taxes did they pay? And then their bottom line net income. Finally, there's the cash flow statement, which kind of unwinds the effects of this accrual accounting that companies adapt. So basically, the effect of GAAP accrual accounting is that cash flow often does not equal your profits. Okay, so when you look at the bottom line profit, that might increase or decrease, and you can look at cash, and it may be quite different in terms of what happened during the period. Usually there are reasons for that, the accrual accounting things like matching your expenses with your revenues. A common example there would be capital expenditures. When you purchase a large facility or a manufacturing facility, you open a new store, the costs associated with that investment are not expensed right away, but you match it over the future periods that you generate revenue from that expense. So over time, you'll depreciate that capital investment in future periods and not in the current period you actually made the cash outflow. So the cash flow statement again kind of unwinds that. So we have separate webinars that kind of go into each of these specific financial statements. But today we're going to kind of look at all of these combined and how that impacts key ratios and again, the warning signs. First, there's no single tell-all ratio. We have a few very important ones and ones we favor that tell more information than others, but there is no single tell-all ratio. So what these ratios ultimately do is lead to questions for the analyst that can dig deeper into why did this go up or this go down, why this ratio increase or decrease or improve or erode. So it leads to other questions. Some of the tools we can use is something called common size analysis. So basically what we're doing is we're taking, say, an expense or a profit and dividing it into sales. Okay? Or we could take a particular balance sheet item and divide it by total assets as well. But we're focusing more on the income statement here today. So the important part of this, and I always just like to use this analysis, is if you're looking at an income statement, you have two companies, right? And they both have $10 profit. If you're just looking at the profit, all right, so they're profitable, but you don't know really if this company is performing better than the other company. Common size analysis will then take that profit, divide it into sales, right? So 10 divided by whatever the sales amount was, and then you get a margin. So the two situations here, you have one company that had $100 in sales, and the other company had $1,000 in sales. So 10 divided by 100 gives you a margin of 10%. So your profit margin there is 10%. The other company, 10 divided by 1,000, profit margin of 1%. So you can see, even though they both have the same absolute profit, company one is a much more profitable, relatively profitable company than company two, and is performing stronger than the other company. So that's common size analysis. You could also do that with expenses, take the expense and divide it into sales, and it helps compare period to period. And it's easier for comparative analysis, which is your next step, where you're looking at different periods. And what you want to do is compare apples to apples. You want to compare the current quarter, say it's a first quarter, with the first quarter of the prior year period. You don't necessarily want to compare that to the fourth quarter, so you don't want to look necessarily at subsequent periods. Obviously, in retail, fourth quarter periods is the holiday period. You're usually going to have very strong sales and profit performance. First quarter period, most likely those sales will trail off, as well as your profits. So it's better to compare the first quarter of this year with the first quarter of last year. So apples to apples. Second quarter this year, second quarter of last year. Well, one way we could kind of smooth out that seasonality from quarter to quarter is use something called trailing 12-month analysis, or TTM. So here we're always going to look at a full 12 months of reporting periods. So if we're looking at the first quarter, we'll look at the first quarter sales, and then the fourth, third, and second quarter of the prior year. So you got a full four quarters or a full 12 months of data in our analysis. As we move to the second quarter, we do the first and second quarter of this year. We drop the second quarter of last year, include the third and fourth quarter. So we're always kind of rolling that 12-month forward. And then we can compare quarter to quarter. So if you look at the first quarter trailing 12-month sales or EBITDA margin for the current year quarter, we can look at it at the fourth quarter, and then as well as the third quarter and the second quarter, you can go back as many quarters as you want because you've kind of smoothed out that seasonality impact. So that's trailing 12-month analysis. It's very important. We use that a lot. Then trend analysis, just as I was saying, going back prior periods. You might, instead of just looking at the first quarter of this year with first quarter of last year, you might want to go back a few quarters and see how things have been trending in that quarter over the last few years. Or look at the trailing 12 month for the last 8 quarters or the last 12 or 16 quarters. And kind of track that trend in that profit measure or sales measure or expense measure, whatever you're looking at, over time and see how it's been trending. Peer analysis. As I did with the common size analysis, you want to compare a company relative to its peers. So that's why the common size analysis is really important, because when you're just looking at absolute dollars, it's kind of difficult to compare, this profit compared to that company's profit if they have much different levels of sales. One company might have much higher sales or lower sales than the other company. So we put it on a margin basis, profit margin or expense margin, so we can compare much more easily with your peers and kind of track that over time as well. As far as profit, we tend to focus mostly on EBITDA. We'll have more on what EBITDA is, but basically it's earnings before you pay any interest, you pay any taxes, and before depreciation and amortization expense. Depreciation and amortization is that non-cash expense from prior periods, so we add that back. So that's EBITDA. That's our favorite profit measure. We use that a lot in our reports, and we'll come back to that with more in subsequent slides. So again, there's no single tell-all ratio. The role of the analyst is to understand the trends and drivers behind margins and ratio changes. So the numbers, the ratios help point to risk. Okay, but then the analyst must go deeper to understand what's behind that shift in that ratio, that margin, that sales performance number, and so on. So why do this? Well, it helps support decision making. Given the risk and the price, is it worth selling goods to this company? Or given the risk, what should we be charging to make the sale worth making? It could support capital management provision. If it's a very risky account, maybe we should have a larger provision for bad debt for this particular account. And support your overall credit portfolio optimization, focusing on minimizing the ratio of risk and return. And where are those risk concentrations? Where should we be focusing on our energy? And if we have a lot of risk, how can we diversify? How can we kind of smooth out some of this risk over time? So the first step with credit analysis is to create a spreadsheet. So use your financial statements and then create a spreadsheet to better interpret the data from those financial statements. So here we have the financial snapshot for Rite Aid. Okay, so we took their fourth quarter and fiscal year data, put it into a database, and we've created this spreadsheet. And you should all be pretty familiar with this financial snapshot. We use it on all our reports. So you could also notice, so we've got our common size analysis because there's lots of margins in here, right? Like gross margin and SG&A margin, EBITDA margin. And there's also comparative analysis. See, we're comparing the fourth quarter ended February 26, 2022 with the fourth quarter of the prior year ended February 27, 2021. And then for the full year, we have sales and so on compared to the prior full year. And then we look at the percentage changes in each of these relative categories. Okay, so if this was third quarter, we'd have third quarter numbers, we'd have the year-to-date numbers, and then we'd have another column for the trailing 12-month data. So essentially, the full fiscal year handles our trailing 12 months, so we've got that. So the first step, again, is spreading the numbers so we could already make a little bit more sense of the financial statements by just doing this. We could kind of see the percent changes for Rite Aid. All right, their sales went up a little bit. Looks like they had a stronger gross margin, but the SG&A margin also increased, so that's a deterioration. So your gross margin is going to be your net sales minus your cost of goods sold. That creates a gross margin. SG&A margin is just those SG&A costs divided by your sales. And then EBITDA EBITDA divided by net interest expenses, your interest coverage, and we're going to cover all these more in depth. But you can already see, just by spreading the numbers, you kind of get a sense of what's going on with this company. And we've kind of breaking it down into three sections. We've got our operating performance, your sales, your costs, and your profits, right? As well as your capital expenditures that you're reinvesting in the business. And then we break out the working capital and liquidity indicators, your cash, your receivables, your inventory, accounts payable, and so on. And then your financial measures, your debt and leverage ratios. How much debt has the company assumed and how healthy are they from a financial standpoint? Okay, so when we look at this, we're kind of looking at it from three different perspectives. The operating performance, the sales, expenses, and income, the financial perspective, the debt, leverage, and some of the working capital and liquidity issues, and also the cash flow, which it will come into later on in the presentation. So with that, I'm going to turn it over to Mike and Franco, who's going to start with our top line sales.
Okay, thank you, Mike. So we're going to talk about sales in this slide. And sales is definitely important. It's usually the first thing we look at to begin gathering information about a company. Declining top line is a big red flag because without strong sales, everything else is going to become much more difficult for the company. But higher sales is not always a positive thing. And as an example, if a company's store base grew by, say, 10%, but sales only went up by 1%, that's something you would want to investigate further and find out why, what's going on. You have X number of stores, but it's not translating into top line. So what we do is generally comps is a better indicator for us, and we'll ask, why did they rise or fall? And if they fell, we ask, well, is it competition? Is a competitor coming into an area? Maybe a new player entered that market, and you had some poor execution of a new strategy that didn't work out so well. Another possibility is cannibalization among stores. A lot of times companies tend to expand too aggressively, especially public companies, to satisfy Wall Street demands. And that brings a whole new list of things to consider, like cost of building and expanding stores, investing in real estate, etc., things like that. These are things that we'll touch on later in the presentation. But for our example here, we have a few charts for Spartan Nash. And Spartan Nash is an average performer. It's rated C1. And it's a good example of why it's best to take several metrics into consideration and not just rely on the first thing you see. In these charts, we see sales and store count are trending downward, but comps have been going upward. Again, the question we always ask is why? So when you look a little deeper into what's happening here at the company, you would find out later on through your investigation that sales have been negatively impacted by poor military distribution segment sales. That's bringing down the top line in total. The store count is lower because the company's been adjusting its portfolio, getting rid of underperforming locations. So that's bringing down the total store count. Now, that's the reason why getting rid of these underperforming stores is why comps are trending upward, even though the total sales have been falling. So if you had just looked at one metric, you really might have missed something else that may have been an important factor in your decision-making process. So you want to look at everything involved. You can go to the next slide.
Yeah, so as Mike's talked about, and again, we prefer comparable store sales, the sales for the stores in this period compared to the prior year period, because it kind of strips out any new stores, any closures, divestitures, or anything like that. So comparable store sales is a kind of a clearer picture of organic growth for that particular company.
All right, and now in this slide, we're going to highlight several products that we use, that we have here for our clients, that are useful not only to see if sales are rising or falling, but also why. Now, the first one at the top is our monitored company quarterly sales report. This is a compilation of our companies that we monitor, grouped by sector. And in that product. It's you know, a quarterly item that we send out by on our website. We show sporting goods here as an example, but all of our monitored sectors are available. And with the quarterly sales report, you see at a glance whose sales are rising and falling. And, you know, just by looking at, taking it across. We provide information on comps as well as 2-year stack comps right now to smooth out the effects of the pandemic. And the report also includes analyst overviews. And that kind of highlights the winners and losers in the sector and any noteworthy market trends that would be driving performance in that particular group of companies. The next product we have in the lower left is our retail openings and closings database. This product tracks future openings and closings for over 25 retail segments, including food and retail, wholesale, mass merch, convenience stores, among others. And the major features of this product include the ability to map future openings and closings among companies. You can receive that data in Excel form, which allows you to manipulate it further on your own. And you're also able to receive customizable email notifications once you set up a portfolio for future openings and closings, which is also pretty helpful. Now on the bottom right, we have the final one that we're highlighting here is our TNT tracker. And TNT doesn't mean explosives at F&D. It stands for tomorrow's news today. This tracker displays store, plant, and facility closings, as well as, it's not shown here, but also anticipated layoffs. Each listing includes an effective date, the precise location, the address of the closing or opening store, and the number of employees that might have been affected by any layoffs. Go to the next slide.
Okay, so moving on. So EBITDA, I promised we'd go into this a little bit more. So again, to gauge a company's profit trends, Credit Intel and F&D feels EBITDA is the best measure. And it stands for earnings before interest, taxes, depreciation, and amortization. Right? So it's a non-GAAP number. It's not something that companies have to specifically report on their income statement. So for example, this is Big Five's income statement for their fiscal year end. And you can see there's no EBITDA on this income statement. So how do we calculate it? Well, there's a couple of different ways. You could start with net income, add back your taxes, interest expense, and then your depreciation expense. Or you could just jump to operating income and add back in your any depreciation expense. Okay, now depreciation expenses, most of it's going to be in your SG&A expense. Some of it might be in your cost of sales. So the easiest way to pull it is just jump to the cash flow statement, and there it is. Your depreciation of expense of about $17.7 million. So if we, for this example, if we took $136 million and added the $17.7 million, you get EBITDA of about $154 million. Okay, and then you divide that into sales of $1.16 billion, and you're going to get a margin of around 13%. For Big Five in terms of their profit margin. Okay, so this presents a truer picture of operating profits by eliminating the non-cash depreciation expense and amortization as well. So most of this is depreciation. And again, that reflects capital expenditures from prior periods that you're now expensing, matching that expense with the current revenues. Amortization has to do with non-real assets that we expense over time, say a trademark, or for say a prescription file if you own a drugstore. They have non-tangible value to the company, but you can amortize this expense over time. Basically expense the cost of that non-tangible asset over time. We're also going to take out non-operating items, right? We're not including taxes and we're not including interest expense. These really have nothing to do with the operations of the business. Okay, so we're just trying to get that pure profit measure. And then we're also going to back out any non-recurring items. Okay, things that don't happen in every period. Maybe it was an insurance settlement. maybe it was an asset sale or gain. If they sold an asset, right? And then they sell an asset, right? When you buy an asset, you put it on the balance sheet, you capitalize it as a fixed asset, and over time you depreciate it, right? So over time, the value will drop. Most of the time when you sell an asset, the market value is going to be higher than the book value that you had on your balance sheet. So that results in a gain. Occasionally, it'll be a loss. Maybe it's an underperforming asset and you just sell it and the market value is actually less than the book value at the time of sale and you create a loss. So that's going to be a one-time loss or a gain. Companies often close stores, so they'll have to write off all the future costs related to that store in the current period, right? So any future rent obligations, they're going to have to calculate what those are and write it all off in the current period. So that didn't happen in the last period. It's not going to happen in the future period. So we're not going to include that. We're going to add back that cost. Same thing with large severance costs, any asset impairment costs. So any of these non-recurring items, one-time items that don't happen on a normal basis, we're going to adjust our EBITDA to create a truer picture and a truer comparison from period to period by adding those numbers back. So that's what we do here internally. We scrub all these numbers ourselves and make sure we're getting the best picture of EBITDA that we can possibly get. Then obviously we take that number, as we did with this Big 5 example, and divide it by sales to get a EBITDA margin number. So question is often, what is behind EBITDA? What drives EBITDA? What's a good EBITDA margin or an EBITDA level? Three basic components of EBITDA. Obviously sales. You're selling product, you're generating a sale. That's the most important part, is that you want more sales to drive more EBITDA, more profit. The other two major components are your cost of goods, right? Your cost of goods that were sold. This is mostly your cost related to your inventory cost. Okay, so how much of that inventory cost related to that item that you just sold? And then you're going to expense it. So, and then that creates a gross profit. So you take your sales minus your cost of goods sold, primarily inventory, and that gives you your gross profit. You take your gross profit and divide it by your sales, and that gives you a gross margin. Okay, that's a profit indicator as well. So you want a higher gross margin. That's better. So the COGS, or the inventory cost, is a variable cost, right? If you don't sell anything, you're not going to have any cost of goods sold, theoretically. It changes your cost of goods sold. The cost of that inventory sold is going to change as you sell more goods or you sell less goods. So the variable itself, it's a variable cost. It's influenced by any markup that the company has from the cost of the inventory themselves. Later on, any markdowns or any promotions that they adapt to sell those goods. Shrinkage, that's going to have a negative impact. Scale, bigger companies have more scale. They're able to buy more of that inventory from you vendors, and usually they do it at a better price. So that'll give them usually a lower cost of good relative to their smaller competitors and improve their overall gross margin. Inflation. Some inflation is usually good for retail. Most of that they can pass on, and that improves their overall gross margin. However, when things get too inflated, like the current environment we're currently in, you're going to have to cut your profit margin to sell that off. You're going to have to absorb that as a retailer, some of those higher costs, because you want to maintain store traffic. You want to maintain your market share. Consumers are going to cut back their spending significantly if you pass on all that high inflation that we're currently seeing. So right now, inflation, retail inflation is in the 8 to 10% range on average. So that means we're very likely going to see some gross margin pressure, like we see with Rite Aid, and I'll get into Rite Aid in a second, but you're going to see this downward trend in gross margins for a lot of retailers, most likely going forward. So that's gross margin. So a little bit of inflation is good, too much is bad. If you're a wholesaler, inflation can be really good, right? If so, a lot of wholesalers, like a pharmaceutical wholesaler, AmerisourceBergen or Cardinal Health, they may buy a lot of product, and then as prices increase, they bought it at cost X, which was, say, $10. Inflation increases the cost to, say, $11. So now that's going to help their overall gross margin profitability. So you can kind of see in a kind of an extreme sense with wholesalers why sometimes inflation can be helpful. And then there's SG&A margin or SG&A costs. SG&A costs are kind of like your overhead, your stickier costs, more fixed costs. These are costs that support the overall operations. It could be your accounting team, your legal, your marketing. So they're more fixed, and they tend not to change with short-term sales shifts. And again, you put this on a margin basis. You divide it into sales to measure the kind of the overall operational efficiency of the company. So the lower the margin, the better. This is an expense margin, so you want to see it lower. So typically, these are a bit fixed again. So when you're generating a lot of sales, usually you're leveraging your SG&A margin. You can kind of see that number trail down a little bit. In periods where you're losing sales and declining sales periods, your SG&A margin more than likely will increase because, again, these costs tend to be a little bit more fixed. Now, every company is slightly different in terms of what they include in gross margin and SG&A margin. As I mentioned, the biggest impact on gross margin is your cost of inventory. But some companies will put a little labor cost in there. They might even put rent in your gross margin if they think that's appropriate. So you can see every company is slightly different in how they do that. And each of these variables will be impacted by a lot of different sales mix of the company. So, again, what's a good margin for a company? It depends on what you're selling and how quickly you sell that product. For example, apparel has a much higher margin. Usually it moves much slower through a retail company's store shelves than, say, drugs, pharmaceuticals that sell a lot quicker in a much lower gross margin business. So the relative mix of your of your sales mix is going to have an impact on all these margins. Okay, so each company might have a slightly distinct gross margin. We'll get to the subsequent slide in a second to kind of point that out. So we're looking at Rite Aid, and you can see, well, a few years back they had an EBITDA margin of 4.5%, 5%, and now it really kind of came way down in the last few years and continued to trickle down in the last few years. So what happened was, if you go back a few years, if you recall, Rite Aid was actually trying to sell itself. They kind of threw in the towel and said, we just can't compete anymore. And they kind of took their eye off operations, and that margin kind of slipped down. The other big component of this was a sales mix shift. A few years back in 2016, they bought a pharmacy benefit management business. So their mix of retail and pharmacy benefit management business. So their overall sales mix shifted to one of a retailer and a pharmacy benefit manager. And pharmacy benefit managers have a lower overall EBITDA margin or lower overall profit margins. So as time passed, their operations slipped. You have that mix shift initially, and then operations continue to kind of decline over the last couple of years. And you can see their gross margin was lower. They were able to offset some of this with some cost cutting of their overhead costs. This big shift back here is primarily related to that mix in the business. Again, the higher mix of the pharmacy benefit management business that they were doing. In last year, their margin ticked up a little bit, but it's interesting to note that most of this improvement, or all of that improvement, was all related to COVID vaccinations. Last year, retail drug companies did a lot of vaccinations for COVID, and this was very profitable for their business. So at least half of this EBITDA that they generated last year was related to COVID vaccinations. So with vaccinations kind of declining in 2022, how are they going to offset that lost revenue and profit going forward? Obviously, they have to sell more or cut costs. And right now, we don't think they're going to be able to sell much more. Hopefully, it'll be a little bit better. But the main focus right now is on cost cutting, including closing stores. And they have plans to close about 145 stores. So I talked about comparing to different sectors and what is a good margin. We can I'm showing some averages here in terms of your gross margin, your SG&A margin, EBITDA margin, even through in your capital expenditure margin, which we'll get to in future periods. But you can see each of these, retail drug compared to drug distribution, much higher gross margin, higher SG&A margin. They have higher overhead costs relative to drug distributors, but they also have overall much higher EBITDA margin. We saw that Rite Aid is really only 3 companies in the retail drug. We have 3 primary public companies in retail drug: Rite Aid, Walgreens, and CVS. CVS's EBITDA margin is 6.6%. Walgreens is 5.1%. So obviously these other 2 competitors are much more profitable than Rite Aid is. But each of these companies is quite distinct as well in terms of their overall sales mix. CVS has its retail business. They also have a pharmacy benefit management business called Caremark, and they also have the insurance business, Aetna. They merged with Aetna a few years ago. And then there's Walgreens, which has its U.S. retail business, its European UK retail business, as well as some remaining drug wholesale business that they do in Europe. They've gotten rid of most of it, but they still have a little bit of that business, so that impacts their overall margin of profitability as well. And then you can see grocery is a much higher business. Department stores, as I mentioned, is a much higher business. And then sporting goods had a really good year in the last year or so, and they're very little promotions. There's a lot of demand for sporting goods, so they really had to reduce their promotions overall during the past year, and that led to them, producing some very good margins. Their EBITDA margin was up, almost 5%, or 5 full points during the last year, and you can see their 14.1 EBITDA margin is even better than department stores overall. And then you can see in terms of what companies are reinvesting in the business is quite distinct as well. Drug distributors don't have to put a lot of money into their physical assets, whereas retailers put a little bit more. We'll come back to that point about capital expenditures in a bit. There's a question about amortization of other assets. Yes, that would be any intangible assets would be included in amortization. And then do you include right-of-use assets and depreciation and amortization expense? There is going to be some depreciation. That, the whole change in the accounting for leases, whether it used to be a capital lease or an operating lease, right? So there was a change in accounting that now these capital leases are more like financial leases, and it's a little bit complicated, but they're still basically capital leases. And yes, so that will be included. Any depreciation related to those expenses will be included in depreciation expense as well, and we'll back that out of EBITDA. So it won't be included in EBITDA. It will be backed out. Okay, so we covered EBITDA. Obviously, people always inquire about net income, bottom line losses, or bottom line income. We do obviously track this. And obviously, if you have a company that has consecutive periods of net losses, that's obviously a huge warning sign. Here we have Sears Holding and Tuesday Morning. Sears went about 10 years with negative bottom line losses. So obviously, you can survive for periods with bottom line losses. But basically, Sears' case, they sold assets to kind of plug their draining cash. But ultimately, they did file bankruptcy in October of 2018. Tuesday Morning, another company, they filed Chapter 11 and early on in the pandemic. They emerged later that year. They closed about 200 stores. They currently operate with about 490. But they continue to see losses, okay? Their second quarter, they had negative operating income for the most of the last few periods since they've emerged from bankruptcy. They continue to report bottom line losses. Their EBITDA in the second quarter was just $3.6 million. And on a trailing 12-month basis, it's been negative since they emerged from bankruptcy. And we do expect them to continue to report negative EBITDA for the second half of this year, fiscal year 2022, which ends in June. So even though they went into bankruptcy, they continue to underperform, and we still are seeing these sharp declines in EBITDA overall. So that's obviously a warning sign. And if the only thing you have to look at is bottom line losses, absolutely pay attention to that. The reason why we don't pay as much attention to net income and net losses as compared to EBITDA is because the bottom line loss or earnings can be noisy. So you've got those non-operating assets and non-operating costs in there, your taxes and interest expense, and all those other one-time items that may be impacting your bottom line profitability. Like Tuesday morning, they had a handful of one-time reorganization costs in their latest quarter. It was only about $5 million, so it wasn't a big impact. But a lot of times companies, especially when they're underperforming, they're going to write off a lot of their assets because they're not worth as much anymore. So these are non-cash write-offs, and that's going to impact your bottom line loss. So that's basically what I mean by these numbers the bottom line numbers can be kind of noisy in terms of really figuring out how is the company really performing in terms of their operating performance during that period. It has a lot of non-operating numbers and data in it. So another question again was, what is a good EBITDA percentage? Will this be based on the industry? Yeah. So as I showed in the prior slide, each sector will have kind of an EBITDA range for the retailers or wholesalers in that particular sector. And again, when you're looking at these numbers, you got to also pay attention to the relative mix of different products that they sell. And with the retail drug, we talked about, each of these have a retail business, a domestic. Walgreens has international. International may be doing better, maybe do a little bit worse. You also have the pharmacy benefit management business, which is a lower margin business. Then you have Aetna, which is an insurer on the CVS as well. So you got to pay attention to the mix as well. But if you're looking more like a sporting goods store, they tend to be more comparable, or a department store, a little bit more comparable, and as well as grocery stores. Not that much difference in the mix from Publix to a Kroger, for example. So those are going to be a lot more comparable in relative to what is the appropriate margin. So if you're in the grocery store sector, the average margin last year was about 7.4%. So for grocery, we usually say, you want to have about 4.5%, 5% EBITDA margin to be considered relatively healthy. Anything below 4%, and you're really starting to underperform, and it's going to be difficult for you to cover your overall costs and generate enough cash flow to be reinvesting in your business and staying a healthy operator. So yeah, each sector will be specific in terms of what's an appropriate margin. So that brings us to one of our next two slides, are two key ratios that we think are really important for any credit analyst to really pay attention to. And the first one is your interest coverage. So this is where we take your EBITDA, your profit, and divide it by your interest expense. Okay, so it's a measurement of how many times a company EBITDA covers its interest expense. The higher the ratio, the healthier the credit. A ratio of 1 time indicates that the company is generating just enough EBITDA to make the minimum interest payments on its debt. So its operations are generating just enough money to make payment on interest expense, and does not have the ability to pay down any principal or invest in any capital expenditures back into the company without getting additional financing. So it's basically saying if it owes any taxes, if it has to pay down any debt, if it wants to reinvest in its business with capital expenditures, it wants to pay any dividends, it's going to have to find new capital. Most likely it's going to have to borrow money. Okay, or it's going to have to use a lot of its existing cash that it might have on its balance sheet. So 1-to-1 means it's just covering its interest expense. Rule of thumb, now we talked about EBITDA margin is sector specific. The reason why this ratio is so great is we have a rule of thumb that anytime it's below 3 to 4 times, that's a warning sign. It doesn't matter what sector you're looking at. It doesn't matter what industry you're looking at. You can look at a manufacturer, a wholesaler, a retailer. Interest coverage will apply. This rule of anything below 3 to 4 times, that's a warning sign, right? So what is this number telling us? Well, we're using EBITDA, the operations, the profit of the company. And we're using interest expense, the financing, the leverage of the company. So we're looking at both the operations and the finances of a company and seeing how healthy they are. So why would a number be below 3 times? Well, maybe you're not generating enough profit. Maybe you don't have necessarily a lot of debt that creates a lot of interest expense, but you just have minimal profits, and that creates a low number. Or maybe the reverse. Maybe your profit's decent, but you've got a lot of leverage. Maybe you just did a leverage buyout and you've got a ton of debt and a lot of interest expense, and that results in a low number. So you can see how we look at this number, it creates a red flag, and then we research why. How is operating performance? How is EBITDA? How is debt? How is interest expense? It leads to other questions that we then answer and just decipher as, what is driving this change? And we can see a company here, again, bringing it back to Tuesday morning. They've had a negative interest coverage, right, for the last few quarters. Now, let's see why. We already know they're generating negative EBITDA because that generated the negative number. The only other reason why this could be is if it was negative interest expense. But in this case, no, they do have interest expense. But they don't have a ton of debt. It's been creeping up since they emerged from bankruptcy, but it's only about $46 million on debt, which a company with about $760 million in annual revenues, that's not necessarily a lot. It's, again, primarily or all because of the low EBITDA or negative EBITDA that this company generates. To put this in perspective, if the company generated an EBITDA margin of just 2%, okay, so that would be about $15 million of EBITDA, your interest coverage would still be around 3 times. So it'd be okay. It'd be in that borderline area. So it wouldn't be so bad. So you can see here it tells a lot more about what's going on with the company. The debt profile isn't so bad. It's just the operating profile of Tuesday morning is really the problem with this company. The next one is called debt to EBITDA. Okay, so similar to interest coverage, but the calculation's a little bit different. Here we're looking at debt divided by your EBITDA. It's a measurement of how many years EBITDA are required to repay all your debt. So how many years will it take us to repay all this debt that we have on our balance sheet? Obviously, the lower the ratio or the lower number of relative years, the healthier the credit. And just like interest coverage, we have a rule of thumb, anything higher than 3 to 4 times. Debt is now the numerator, so we want a lower number, right? So anything higher than 3 or 4 times is a warning sign. And like interest coverage, this can be applied to any sector, any industry. So again, it's going to show why is it the number too high. Let's say we take a company like Restaurant Brands, which is a franchisor of Burger King, which was currently around 6 times. Why is that? Is it a function of they have too much debt? Is it a function of they don't have enough profit? Or in their case, it's a combination of both. Okay, so could be both, could be one or the other. Again, it points to questions. What is driving this this ratio, and what is behind it? Why is it bad? Why is it trending positively or negatively? And here we have a snapshot of debt to EBITDA for all the casual dining, fast casual, and quick service restaurant sector. So the current year and the prior year. And you can see for the most part, we're seeing numbers kind of come down, track, and got a little bit better. So 2021, the top line compared to 2020, the bottom line of each of these companies. Obviously, 2020 was impacted by the pandemic, the shutdown, the social distancing, and all that. And a lot of these companies had poor EBITDA, and they also had to borrow more money to support their operations to get through that period. Then things kind of rebounded in 2021. So for the most part, these ratios saw some improvement. So again, interest coverage and debt to EBITDA, make sure you understand these ratios. Make sure you have a clear understanding of what we're talking about in our reports and what are the key warning signs for these types of companies. If you don't, get on the phone and call one of the analysts and we can go over it with you one-on-one. So what happens then when a company you're going through the operations, you're going through interest coverage and debt to EBITDA, and you're seeing lots of warning signs? The next step is to kind of assess the liquidity. Obviously, cash is king, but there are other sources of liquidity as well. But before you get to that, you want to look at, well, how much cash do they have and what kind of cash are they generating? Free cash flow is a good measure of cash flow generation. It's one we refer to quite often. This is a number from the cash flow statement. Again, that unwinds all the accrual accounting to get your cash flow actually from operations. Okay, so it's got three sections: your cash from operations, your cash for investing, primarily your capital expenditures, and then your financing cash flows, whether you borrowed money, repaid money, issued any dividends or any of that stuff. So free cash flow is just that cash from operations. So it's basically your net income and then unwinding all the accrual accounting, adding back depreciation, any changes in your working capital and things like that. And again, we have another webinar that discusses all those things in depth. But cash from operations, then you back out those investments, those capital expenditures, the money you're putting back into the business. Is it positive? Is it declining? Is it negative? And if it is negative, how is a company going to be able to invest in the company? How are they going to be able to fund their operations? Do they have cash? Do they have a revolver? What is that cash burn rate? And given the liquidity, how can they plug any cash shortages in future periods? So with that, I'm going to kind of turn it over to Mike and Franco, and he's going
to. Okay, so we talk about the revolver, the company's revolver, and as we say on the slide, one of the last options for liquidity, a buffer option for liquidity. So under ideal conditions, a retailer would borrow against its credit facility, mostly when stockpiling inventory, probably during its peak selling season or just prior to that season. If a company is cash flow positive, we would expect it to be able to repay some, if not all, of those borrowings after that high season. Conversely, if a company is not free cash flow positive, borrowings will increase and the available credit will deteriorate. So if revolver availability declines, we again, as we've begun through this whole presentation, the question we're always asking is why. So we're going to ask again, why? Well, could be as simple as a couple of very, very minor things. A company could have amended its own facility, reducing the size, decided it needed less credit, reducing it, saved some money in commitment fees. So it might have been a proactive approach to just reduce the size of the facility. So that's why there's less availability. But more important reasons could be that they've increased their borrowings because they need more funds to operate that they didn't before. Maybe they're not doing as well, and they need to tap into that a little more. That reduces total availability. And you go further, another reason might be that the company's short-term assets, inventory, accounts receivable, are often pledged as security for the revolver, and those might have fallen. And in that case, you were dealing with a borrowing base that would limit a revolver's availability by allowing the company to only borrow up to a certain percentage of its eligible inventory or accounts receivable, regardless of what the maximum of the facility is. It could be, $500 million, but the borrowing base might take you below that. So the $500 million is, not an actual number if the borrowing base brings it down lower. So if these metrics decline, the facility's borrowing base decline as well, and that reduces capacity. So we also have covenants, and banks usually demand that a borrower comply with certain of these covenants. Example might be, for example, just say a bank might say to a company that has to maintain a minimum of $10 million under its facility at all times. It has to have that much available. There may be financial covenants tied to operating performance or its balance sheet. These covenants might say your leverage ratio can't be higher than a predetermined level in the indenture, or your interest coverage can't go below a certain level, right? And what this is basically saying, to break it down to give an example, if your leverage ratio restricts your debt to EBITDA to say 2 times, and you want to borrow another $10 million, but that bumps up leverage now to 2.1 times. You really don't have access to that extra 10 million, at the end of the day, since that'll put you in violation of your covenant. So that's why it's really, it's important to understand these covenants going in. And in the cases of companies that might be performing poorly, not so much, in strong companies, it's important to understand these covenants, stress test them, and determine whether it's from a decline in sales or increased leverage, negative free cash flow, etc. All those kinds of things, just to be aware of how much the company that you're looking into is realistically able to borrow before it is limited by one of these covenants. So in this next slide, we kind of put together our revolver availability for companies. And when we're asked what a concerning level of availability is, generally we use 25%. In the slide that we have here, we're showing grocers, and most of them have very high availability levels. And grocers have been generating a tremendous amount of cash during the pandemic, and that's generally limited their need to tap into revolvers. Down at the bottom, though, you see we have Sprouts. They've been investing in store expansion lately. And at the very bottom, we have Spartan Nash, a bit of an underperformer, as we mentioned earlier. And that could explain a little bit of why they're a bit below the pack. But they're still above that 25% level. And again, as we've said, Mike's mentioned many times, the 25% warning threshold is just a starting point with any investigation or discussion. And you should use it in conjunction with other metrics, as we've already mentioned. And I give you one of my own examples is a C-store distributor that I happen to cover always operates with very little cash on hand and relies heavily on its revolver. And oftentimes, this convenience store distributor, there'll be instances when cigarette manufacturers announce price hikes, or states will bump up their taxes, and that'll prompt the company to load up on inventory, really load up on inventory ahead of those changes to capture some easy gains just by holding inventory. In these instances, the company is taking revolver down way below 25% to finance that inventory. But invariably, especially with a thing like cigarettes, something that doesn't get discounted or go from season to season, they pay it down the next quarter or two as they sell off that stockpile. So again, that's just one. It's a little bit off the beaten path as far as what you would normally see, but it's an example of why you wouldn't just use that number on its own to make your decision. And in our next slide, we're highlighting another one of our products. This is the retail debt database, and that's a relatively new product. This displays all available metrics of retail bonds that we cover, term loans, also revolvers, the whole group of them. And it'll give you the size, the amount outstanding, maturity date, security, upcoming payments, the interest rate for a particular instrument. The database is pretty much real time. It's updated by our analysts throughout the day. And users can filter and sort data by company, by industry or instrument type, depending on your needs or what you want to pull out. Credit ratings also, and maturity. And just like some of our other products I spoke about earlier, you can create and share, customized reports with your team and others when you use this product.
Okay, so just summarize again: liquidity, cash is king. Understand cash flows, understanding what access to cash, looking at the debt, understanding secured versus unsecured debt, looking at the asset base in terms of long-term assets. That may provide a little bit of additional liquidity. Do they own other businesses? Do they own real estate, the stores, the banners? Can they sell any of these and monetize those assets? that can provide liquidity as well. Any inventory liquidations that can provide liquidation proceeds as well. Persistent asset sales could highlight, obviously, financial liquidities, as we saw a few years back with Sears, obviously. But, these are tools that companies provide them a little bit of financial flexibility when other sources of capital and cash flow kind of dry up. But getting back to free cash flow again, and again, that's calculated with cash from operations minus your capital expenditures. We can also add back interest expense and then look at that free cash flow before interest expense to kind of calculate another interest coverage number called free cash flow divided by interest expense. So how much actual cash flow, instead of the EBITDA, we're looking at actual cash flow before interest to kind of see how much actual cash flow they have to cover that interest nut that they need to come up with. In this case, we've got GameStop, and they've been generating negative free cash flow last year, almost $500 million in cash flow. Interestingly, though, you can see their debt came down and their cash actually increased significantly last year. So how did that happen? They burned cash from operations. They could have sold assets. That wouldn't be in that number, but you can see cash from investing was actually negative. That would show up there. So in this situation, it's all the cash from financing. GameStop was one of these meme stocks. Their stock went through the roof, so it allowed them to sell about $1.7 billion of their own stock last year, and that boosted their overall cash, plugged this cash drain, and allowed them to pay off most of their debt. So even though their operations are doing very poorly, they generated $434 million in negative operating cash flow last year because their profitability just continues to underperform. They still have a very strong financial situation because of this highly unusual situation that they're kind of a meme stock. So looking forward, you want to understand, well, if operations continue to burn around $500 million a year, what might impact that number going forward? And we don't expect their operating performance to kind of improve. Their brick and mortar business has kind of been underperforming. There's been an industry shift away from hard software and hard goods, and more gamers are kind of going online or using PCs and not going to the store and buying that software. So that's their story. So they're trying to shift to a new model, and that's going to cost money as well. So we expect their cash to continue to decline this year. Hopefully this $1.3 billion and $1.6 billion in total liquidity, including the revolver availability and little cash, is enough to get them through the next 6 to 12 months. So when all those sources of capital and liquidity kind of dry up, the last source of financing is usually the accounts payable. They start to lean on you guys a little bit more. And one way we can kind of track that is look at your days payable outstanding. So that's basically taking your accounts payable and dividing about 1 day's cost of goods sold, or 1 day inventory. So again, cost of sales is roughly your inventory. So if you take 1 day inventory divided by your accounts payable, it basically shows you how long it takes you on average to repay your vendors. And any movement up or down could be an indication that there's a problem here. Usually you want relative consistency from period to period. And here you can see the Casper, the mattress company, increased significantly over the last couple of years. They just became a public company back in 2019. And then this January became a private company again. So it's very short-lived public history, but it's a good example of an increase of days payable outstanding because of their poor inventory management. You can see also the inventory turnover declined sharply. That means they're selling their inventory a lot slower, and they're taking longer to pay you guys in general. The other big change for Casper was a mix shift. Their customers kind of changed. They went from selling mostly direct to consumer to having more retail partners, so selling their product in other retailers. And that had somewhat of an impact on these numbers as well, a negative impact. But most of that had to do with the poor inventory management and leading on the trade a lot more than they had in the past. So Casper is certainly an account that you'd want to pay attention to. So we were looking mainly at financial statements. A lot of times you have private companies where you don't have financial statements. So in this situation, another way of tracking accounts payable is looking at their payment trends over time. And obviously we have our ARMS payment score, or APS, that we track each month based on the trade data we're getting from you guys. And this is an example of a company called Antero Brands, formerly known as Running Specialty Group, and they do business as Olympia Sports and Shoes.com. And you can see over the last few months, their payments have declined significantly over the last few months. And actually, that continued to decline in February and March. Those numbers came down into the 100 and 200 range for each of their specific subsidiaries. So this is a company we're getting a lot of reports that there's been slow or no payment, lack of communication. Recently, actually yesterday, we uncovered that the Shoes.com website is now being diverted to DSW. So if you haven't seen that, you have exposure to this company, check out our alert on the website or give me a call. So for these private companies, pay attention to APS trends and make sure it's a nice, healthy 900 or better APS score. And then the capital investments, we've been talking about that. These are your capital expenditures. And you can kind of gauge this compared to your peers and over time by looking at your CapEx margin, taking in the capital expenditures as a percentage of sales. It's a good tool in terms of, is a company investing too much or too little into its business? Most retail will be in the close to 2% range for normal upkeeps, modest amount of remodels, investments in technology and other enhancements. Here we have the grocery sector, and these numbers have ticked up in the last couple of years. It was up slightly on average from 2.3 to 2.6%. What we're seeing throughout retail is more investment in digital. Obviously, since the pandemic, omni-channel and online sales really took off. So a lot of companies are investing more and more on their digital and technological capabilities, including improving efficiencies in their supply chain. And that's been the primary focus for most grocers in the last couple of years, and particularly again since the pandemic. Store growth has been much more limited, and remodels have obviously been a big number as well. But at least half of this has been for most of the grocers in technology and supply chain investments, and that's something we're seeing again throughout the sector. Generally, again, and this is kind of sector specific, you're going to see higher margins for department stores where you have to invest in a lot in your physical assets compared to, say, a wholesaler, like, again, the drug distributors. They might have a CapEx margin of 0.5% or less, so very little capital investments. They have very little fixed assets they have to invest in, so their CapEx margin is much lower. And that makes sense too, right? Because department stores tend to have a profit margin closer to 10%, whereas we saw the drug wholesalers' profit margin is closer to 2%. So hopefully you're not in a business where you have a very low margin. You have to invest a lot as well. How are you going to generate the cash flow to do that with such a low margin? So it is sector specific. For most retailers, anything less than 1% would kind of be a warning sign. This is where a company really probably isn't even doing the basics to keep their stores fresh and looking good. And that would be kind of where we would see a warning sign, anything less than 1%. And most of these grocers are 1% or more. Other warning signs, tracking store closures. If a company's selling a lot of stores, that's a warning sign. This is Shopko. If you were tracking their store closures leading up to their January 2019 bankruptcy, you could see they were closing a number of locations. That obviously is a concern. Most of the time when you close a store, you still have rent obligations related to that store. So you're going to have to continue to pay that rent even though the store location is closed. And that rent cost is no longer included in your financial statements, right? So when you decide to close or divest or wind down a business, you take all the future costs related to that business and write it off in the current period. So it's any future actual cash outflows related to that store or business are no longer reflected in the P&L. So now you have something called dark store rent that negatively impacts your cash flow. So obviously, if you're closing lots of stores and you've got this dark store rent, you're not generating any sales from those stores, that could be a reason for a company to file Chapter 11 to get out from underneath all those leased locations. Market share, obviously that's an important measure. If you've got data, particularly again for private companies like Southeastern Grocers, you can see this company, even though their performance and the grocers overall did well in the last couple of years, they have been ceding market share to the competitors, including Walmart and Publix, which compete in most of their markets. You could also look at overlap. How many competitors are in a company's particular markets? And is that a concern? And, we have our retail tools business. We have our store overlap analysis product where we can track how many, in this situation, Academy, how many competing Dick's stores are within 5 miles of an existing Academy location. And you can see that about 102 stores are within 5 miles of an Academy, or about 146 are within 10 miles. And this number has been increasing over the last couple of years. So obviously that would be a warning sign for Academy to have a much stronger operator like Dick's moving into your markets. And then we've got our credit rating. And that's kind of like an amalgamation of, or an aggregation of all these different ratios and numbers that we've been looking at, and kind of pumps out what we call a credit rating score between A1 to F2. This is kind of a rough estimate of where we would view each of these credit qualities. A C would kind of be satisfactory. Anything D or less, these are the accounts. Those are the, those 20% of the accounts you really want to focus in on, and make sure you're understanding your credit risk exposure with these accounts in terms of their liquidity and their cash flow and any future obligations they have going forward. Generally, most bankruptcies occur in the E or F range, although we do occasionally get some E companies that kind of linger in that area. Rite Aid would be an example. They've kind of been an E1 credit rating for most of the last 10, 20 years. So that's really, again, if you see E or F, immediate warning sign. Let's investigate what's going on with this company. Do they have enough liquidity or options to get through the next 6 to 12 months? Then tracking them all together, here's our apparel categories. And as you can see, apparel kind of rebounded last year after a dismal 2020. And most of these accounts had upgrades, even the Express and J-Jill, which are rated D and E, D2 and E1 respectively. Some other things you can kind of pay attention to are the financial markets. Stock prices, if you were just simply tracking Sears Holdings stock price, you would have, some flags should have been going off that, their stock is now well below $10. It was trading in less than $1 before it filed Chapter 11. Bond prices are really important. If there's enough data out there, we put our bond pricing in our Bond Watch report. And if you were paying attention to Toys R Us prior to their Chapter 11, you could see their bond prices really dropped off a cliff during the second half of 2017, between August and September, just in a matter of weeks before they filed Chapter 11. And you can kind of track that relative to their yield to maturity, or generally these bonds, if you issued the bonds at 7.4% roughly yield, and now it's yielding 60% because the price of the bond dropped so much from the par value of roughly $100 to $60. Investors are demanding a lot of money from this to take on the additional risk. And bonds are a good indicator for trade in terms of any unsecured bonds. So these bonds are unsecured. They would give you a quick idea or rough estimate of a liquidation value based on the bond investors' analysis of the company performance and their default probability, and if, when they do default, what type of likely payout will you get? So once a company does go into Chapter 11, if you're trying to track the bond values, that can give you a rough estimate. It's not an exact science, but it gives you kind of a rough estimate because unsecured debt is in the same category as general unsecured trade claims. And then some other criteria, obviously, to pay attention to, management credibility and turnover. If there's a lot of turnover in the C-suite, do they have a strong management team, private equity ownership? New store openings, are they growing too aggressively? Are they acquiring too much assets? That's a warning sign, because it takes money to grow. You've got to spend money to acquire those assets, to open new stores, and then to put money, the inventory into those locations as well. So growth takes money, and that's a warning sign. You don't want to be growing too aggressively. Comments like conserving or managing cash flow, that usually means the company's going to pay you guys slower. It'll probably also cut their capital expenditures, so make their future viability less viable, any dividend reductions or anything like that. If they're pursuing significant asset sales, that could be a warning sign. Look at the health of their own customer base if they're a wholesaler. Let's say if you're a drug wholesaler and you're selling to Rite Aid and you're concerned about Rite Aid, and this wholesaler does 50% of their business through Rite Aid, that should be a warning sign to you that there's a concern there. Loans or any guarantees or subleasing arrangements. Maybe a company sold an asset and they guaranteed the leases related to all those stores, and that company that acquired the business is now highly leveraged. They're not doing too well. Even though they sold the stores, they still guaranteed the lease. So if that company files Chapter 11, they're going to be on the hook still for those leases. So pay attention to that. Any SEC or other investigations, obviously that's a concern. And then we talked about dark stores or any other unfavorable contracts a company might have or is facing. Those should be warning signs as well. So that's it. I'm sorry I went a little bit over today. We'll stop and pause for any questions, or you could also submit to me or Mike any questions you might have or follow-up inquiries on the presentation. It will be available on the website tomorrow with audio, so that's out there. But there was one question about EBITDA. It says, I've been seeing companies make a lot of adjustments to EBITDA called adjusted EBITDA. Is there any standard? Yeah, I mean, more companies are kind of reporting EBITDA in the last couple of years, and they do call it adjusted EBITDA. Most of the time, that kind of jives with what we would calculate ourselves, our own EBITDA calculation. Sometimes it doesn't. Let's take the Rite Aid example. Or, one of the things they were doing was a COVID cost, payroll cost that they kind of carved out and said, well, we're going to add that back into our EBITDA number. We didn't do that. We left those payroll costs in as is. We thought those costs were a little bit sticky. Yeah, there were some bonuses in there, but for the most part, that was higher pay, and I think a lot of those higher costs are sticking. And then obviously we have a lot of increases in the minimum wage. So we don't always agree with a company's adjusted EBITDA number. We may be off slightly with that calculation. Again, we scrub the numbers ourselves and do our own calculations. I think that's it with questions. So I want to thank everyone again. Feel free to reach out, and we'd love to hear from you. Any feedback you have on the presentation, we'd love to get as well. All right. Thanks, everyone, and talk to you all soon.
Thank you.